Welcome back, listeners. Money in the Tank, episode 60. It's great to be back with you all. We're a man down today with Brad missing. It was me last week. It's Brad this week, and I'm sure it'll be Arnie next week. But we're here to provide you guys all the latest and updated news items of all the goings on in the financial world and give you some general tips and help and guidance and education only information to hopefully help provide clarity on just all financial markets and just decisions in general in life, and provide you with a bit of fun and easy listening along the way. So without further ado, my name is Joel Seach, Principal Advisor, Harpel FG, and to my left today...
And right, it's Arnie, Finance Professional.
Finance Professional, great. So it's great to be back with you guys today, the Tankers. So if there's any first-time listeners out there, this is our episode 60, so you can go back to episodes all the way through, and there's different topics. Some are market updates, but then there's stuff that's going to be perpetual in nature in terms of talking about fundamentals of investing and share trading and property and real estate and broking and all those things. So you might find some topics or subjects in there that you're interested to go back to in previous episodes, because I've had a few people say they want to start to jump on the tank train. So that's what I mentioned to them. So if you are a new listener, go back and check some of that stuff out. We do sometimes have episodes where we'll go to subject matter experts, which we will be doing coming up in future episodes. We've got some good guests lined up to talk about that, but we also do market ones as well. So Arnie, where can the listeners get us at, and where's the best place to reach us at if they've got any questions?
Yeah, please get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook, and leave a like, comment, subscribe on YouTube, and hit the bell. We prefer comments on the YouTube, but you can get us through any channel.
Fantastic, great. We've got a great episode lined up today, guys. So tankers, stay tuned. So we've got all the latest with the banking craziness that's been going on in the US and a bit of Europe as well, and what the latest is around that. So how the bailouts have been working, how it sort of we spoke about how it started last week with Brad and Arnie, how the insurance side of things work and how the bailouts would work. And then what's, I guess, the flow and effect as to what's been happening with the markets. And then that leads us into, the RBA and the Federal Reserve and the European banks as to maybe what's to be expected coming up for the remainder of the year as well. So it's just been a bit of a crazy month or so in terms of markets and the whole banking situation that started to crop up the last few weeks.
Spot on, mate. So before we get there, do you want to give us the Rivkins rules? Or?
Absolutely. And the Rivkins today, as well as a good 50-50 at the end of the pod, and also a Q&A as well. So hang around for that too. So we are at page 112 or 113 of the Bible. So I've got two on here. So I'm just wondering if I give two for one today or just stick with one. Renee on life. I am unfit because I do not do sport. Nigel is unfit because he does. Who's Nigel?
I have no idea.
That makes no sense to me. I probably should have read the book maybe, and I'd know who Nigel. So I'm unfit because I do not do sport. Nigel is unfit because he does. Makes no sense to me, that one. The one on the other page is, don't believe what you hear or read in the press. I know because only 50% of what is written about me is correct. So that's a bit of me time again for Riv there. So
I think that's a good lesson though, that one. And I'm keen to hear your thoughts, Jolly, but I feel like you've always got to be skeptical when reading media reports.
For sure. And this book is 1999. So I'd say even more than from 99 to 24 years to now, that has gotten worse in terms of what you're reading, the clickbait, the headline grabbers, the information or misinformation or misrepresentation or misquoting. It's a lot of it sifting through the line, sifting through the crap and the noise and getting to what the actual crux of what it is that is there. Because the news media more than ever is out there to grab headlines and grab readers and grab clicks and because you won't go back if they don't, or you don't click into it if it's not grabby. So I think more than ever in the current internet and social media age, that stuff's just super prevalent, which is half the battle, I think, and part of the reason we run this podcast is to help educate people on, sound decisions, or just generally unsifting through all the noise and all the crap that goes on in the current environment.
Absolutely. And especially when it comes to finance products or anything really, it's quite often the case where articles or opinion pieces are placed and there's money that exchanges hands, and you're not, maybe not getting the full picture. I forget what that question we had last year was regarding that sort of savings account for kids. But I feel like that's a prime example of a product where it has to be careful what you read, because I'm sure they would partner with different publications to, to get it out there.
Yeah, and I'm in the finance world, and there's conflicts of interest everywhere you look in finance, and whether it's a certain product or a certain bank or a certain publication that's leading you to a product, and that's really what they try to do is they try to sell product as opposed to guide and educate and advise, and that's where I guess our niche is in terms of how we help clients. But the big marketing, the big beast that is marketing, it's all filtering down to get you into a product, a institution, a platform, a whatever. And the sifting through all that is where I think you can kind of help navigate that treacherous path and journey that can be finances. And that's why we love doing the pod, to help with those beginners and intermediates, to sort of help sift through the noise, essentially.
Absolutely, mate. So, well, today, we're like, as John mentioned, we're going to jump into, this continuing fallout of what's going on in the banking sector. I've got a few news items here, Jolly, which I'll just sort of touch on, and you can give me your thoughts. And I know you've got a couple as well. But there was news pretty recently, a couple of days ago, that there's going to be probably a huge merger in the banking world, which is UBS taking over or merging with Credit Suisse. And it looks like this is going to be for consideration of 3 billion Swiss francs, which equates to about 4.8 billion Australian dollars. And it's a move that's made to save this embattled lender. So there's a few different moving pieces here. Interestingly, Credit Suisse is a 167-year-old bank, and they've just been in turmoil for a long time. Brad made a comment offline last week about how Credit Suisse has sort of had trouble for like the last, 20 years or so. And I actually saw this interesting tweet earlier, which I don't have handy, which showed that Credit Suisse on average for like the last 10, 15 years has been fined about $500 million every year. No, hang on. Yeah, about $500 million every year. So, they've definitely had a lot of issues. One major point of contention from this deal going through with UBS and Credit Suisse is that the AT1 bondholders in Credit Suisse have actually had the seniority of the bonds placed below equity because of the way this deal has been structured. So, tankers, what would normally happen in a situation where a company goes into administration or insolvency is that there's an order to which people get paid out. And normally that would be, senior secured loans, senior unsecured, and then unsecured. And it goes all the way down through the list, down to bonds. And then equity would typically be last, equity being ordinary, stock. But in this scenario, these AT1 bonds are being placed below equity, and they're not going to get their money back. So have you heard anything about this, Jolie?
It's a good point you're making. That's what I was going to explain, that if you've done a good job in terms of explaining the hierarchy of what gets first, second, and third priority. So one of the interesting emails that we come across the desk during the week was obviously the takeover. So UBS agreeing to buy Credit Suisse for 3 billion francs, and then the National Bank, or the Swiss National Bank, agreed to offer up 110 billion of liquidity line to UBS to be able to help with that takeover. So that then provides the liquidity for UBS to carry out takeover and continue business activities of both banks without the restrictions or interruptions. Then it talked about the outcome for the Credit Suisse bondholders varies depending on their position and the capital structure. So all the Credit Suisse senior debt being assumed by UBS, so moving from the BBB rated entity to an A rated entity, and then the AT1, which you referred to before, Arnie. So they got zeroed out under the decision by the Swiss regulator to write them down. So that it allows all shareholders to be compensated, but the categorization hierarchy takes a hit. So the government support will trigger that write down of the AT1 shares of Credit Suisse, and it's around 17 billion, I think. So it's an increase in the capital. So the takeover will result in UBS becoming the second largest wealth manager with 5 trillion AUM, advice under management, I think they call it. undisputed leader in Switzerland, and the biggest size will require higher capital buffers. So we might have spoken about it on previous podcasts, but the capital buffers to ensure they've got liquidity there. So then, transition periods will be worked out, and then the transaction will provide UBS with a significant 25 billion of downside protection. There's a whole bunch that's going on in relation to that. So in a nutshell, UBS taking over Credit Suisse and UBS becoming a behemoth, bigger than it already was. It's an interesting way how it's all come about. And you mentioned Credit Suisse maybe hasn't operated as well as it could have been for the last number of years. And I remember, I think, listening to a podcast about, or reading something about the bonuses that the Credit Suisse managers and whatnot get there, and whether they're making the targets or they're not, or they're doing things right. It's always a bit of a convoluted thing, that.
Yeah, and you're right. Yeah, so you got the figures spot on there, Jolly. I think 100 billion Swiss francs in liquidity assistance, and they reckon this deal is going to close by the end of 2023. This AT1 bond issue is actually unique. I don't think I've ever seen anything like that. And I know that the bond holders themselves are putting together a lawsuit to try and have that decision overturned. But I was reading some commentary on Finance Twitter, and they were basically saying, some parties were saying that if you actually look at the documents underlying these bonds, the option to zero them is written in. So they followed the rule of law. But then some are saying some are saying they put a law in as part of this merger, they sort of rushed it through, which allowed them to change that hierarchy to do so. So I don't know who's right and who's wrong here, but I'm sort of following along.
Because usually your bonds is you've got a fairly stable instrument there in terms of you buying a bond to get a coupon payment back and then get the principal of the bond back. And on the secondary market, the bond value can change, but you're usually receiving something back, whereas, being written down is interesting.
Spot on, mate. And then the second one, which is, again, continuing saga in America. So Brad and I covered last week, from memory, what happened with Silicon Valley Bank and then with Signature Bank. But another big bank that's been in the news is First Republic. And at that point in time, when we did the last pod, JP Morgan had just organized 70 billion in extra funding for that bank to address their depositor liquidity concerns. At the same time, they got access to another 30 billion from a consortium of banks. And then on top of that, the US government has organized a facility for all regional banks. I think it's up to 25 or 30 billion, where they can replace those distressed assets if they have them with new assets. So this bank has been given a lot of support of late. And it seems like they're still in trouble because, as of yesterday, JP Morgan is trying to organize another lifeline for this First Republic Bank. So I'm not 100% sure on the figures of how many deposits have been withdrawn from this bank, but they've taken a huge hit, Jolly. So I think just here it says that the share price has plummeted 90% to record lows. Have you kept up with this one, First Republic?
No, I haven't. So you might have to be the leader on this one, Arn.
No worries, mate. Well, in a nutshell, that's basically what it is. So I guess people are now sort of trying to understand what's going to happen with this bank. Janet Yellen, who is the Treasury Secretary, came out a couple of days ago in America. It would have been 21st of March. What's that? Is that yesterday? And basically sort of said, she didn't specifically mention First Republic Bank, but she said that if the Treasury and the government needs to step in, they're willing to take further action to guarantee that the bank deposits are safe. So they're trying to backstop these deposits. They're trying to stop this bank run and this fear and this contagion, which is kicked off and sparked by this whole their Signature and Silicon Valley Bank. But the regional institutions, not all of them are suffering the same fate, but this one in particular has suffered a huge bank run, and we don't know exact figures of what deposits have been withdrawn, but I don't know what more the government can do here because, if deposits do go to zero, that bank business model is cactus. Even though the government has said they'll step in and are willing to, give it a backstop. And it kind of leads nicely into the next thing we want to talk about, which is the FDIC insurance. And at the moment, the limit for that is 250K. And I know you wanted to have a chat about this, so maybe we could take it there.
Yeah, that's it, mate. And I think talking pre-pod, the the main thing the government over there is trying to do is to instill confidence in the system, and that's part of it is just saying that they're willing to step in and do what it takes to protect people's funds in banks to stop that bank run and that exodus of money. So I guess essentially with the FDIC, the insurance, so like the US authorities have guaranteed deposits of up to 250K, which is usually covered by that deposit insurance, but the Fed's unveiled a term funding facility, so that enables the banks to borrow cheaply from the Fed in order to avoid selling those bonds at a loss that the bank has to hold as capital. So they don't want to have to sell them down in a fire sale. They want to be able to keep them, get the money from the Fed, and then pay that Fed back in due course. To allow that to happen, it's borrowed cheaply from the Fed to do that, to avoid that fire sale. So that's what they're hoping will help minimise the bigger problems that the companies may have, such as bank runs or paying these deposits or layoffs or not paying creditors, essentially. It's similar to Australia. Australia has that government guarantee on the 250K per institution, but it was never really like our banking system here with the four big banks. It was never really going to be needed to be taken up because we're just in a different ball game. But it's almost like the government at the time, back in 2008, which is the global financial crisis, was instilling confidence in the consumer to say, don't worry, we're here to back up and get you through. A bit like what happened in COVID, when we went to a countrywide lockdown right at the start, it was like, don't worry, we're going to be able to make sure we help people get through this time, instilling confidence in the people so that you don't cause all these big ramifications that can spread further and further, such as a bank run in this circumstance.
Can I just clarify, Jolly, because I wasn't sure about this. So that facility that you're mentioning, I did read the statement that came out from the Federal Reserve. That was the one that talked about how they were going to backstop SVB and Signature fully. And then there was the facility that you mentioned, which talks about the short-term like loan or funding for the banks. But was there also, I feel like there was also, is that the same facility that's going to be used to, yeah, sorry, I think I'm getting my wires crossed here. Was there another incentive that they did alongside that facility, or am I getting my wires crossed?
I don't know. All I know is that they had that usual guarantee of the 250K, but then they quickly moved to, the US authorities and moved to guarantee deposits above that. So beyond the 250K, under that term funding facility. So that enables those banks to borrow cheaply from the Fed directly to avoid having to sell the bonds to guarantee depositors' money essentially above the 250K. So that's sort of the latest that I've known about it from an update perspective.
Yeah, you're right, mate. Sorry, I just found out what it was. Yeah, you're right. And in conjunction with that, the Fed is easing the conditions by having a different discount window. So it's going to use the same conditions, but over the facility is going to have more favourable terms to the banks over that 1 year period.
Yeah, and I guess that then leads us into the listener question this week from Kyle. So thanks for writing in, Kyle, asking about this because it's really prevalent and a current topical question. It's what's happening with the rates and where do we see them going? Obviously, general in nature for the remainder of 23 and then into 24. Does it mean the central banks? So Kyle asked, what do we feel about the rates, where they're going, and are the central banks nearly done? So it's a really good question. So I guess in terms of inflation, if we feel that it's going to fall going forward, we're going to have some bumps along the way, then central banks generalizing here potentially are at or near the top. And they've got more flexibility to respond on a downward perspective if a financial crisis ensues. So like we're experiencing with the current banking issues. So, what's happened the last 12 months with all these rate hikes has now given the banks a buffer to be able to adjust down if they need to, if we see an unraveling of economies and recession fears start to really come into play, because they've got that buffer. Previously, look back 12 months retrospectively, we had no buffer there. So that's, partially they've raised to give them the buffer. So obviously whether, there's banks that's going to have potential losses on their bond portfolios, that's going to put some pressure on central banks to provide that liquidity, which we spoke about. But, where do we see it going? So I guess the European Central Bank, they're a little bit behind. So they've possibly got a bit more further to go in terms of rate hikes than other central banks. But again, the US being the main economy that sort of feeds into all the other economies, that may cause them to potentially slow down. There's a bit of a dot point on the Bank of Canada has held rates at 4.5, and they might have peaked. The Feds have been signaling more rate hikes, and I know, Arnie, you've got a bit to speak about there. They've signaled more rate hikes, but then potentially, I think Jerome Powell has come out potentially talking about maybe slowing, or I think coming into having a meeting tonight, Arnie, and there's about an 85% chance of a 25 base case hike and a 15% of a zero move, whereas previously it was more leaning towards maybe is there another 50 in there or even higher?
Yeah, you're spot on. So by the time this pod comes out, we'll know the answer to this. But yeah, like what's going to happen at the FOMC meeting? A lot of the talking heads, a lot of the pundits are saying, are they going to pause? Are they going to cut? I think you're right, though, 75, 85% chance that they're going to raise it by 25 basis points. Feeding into Kyle's question, which is a great question, I sort of wonder, like, where do I see it going? I could see either scenario playing out in the short term, but I do think that, like what you said is 100% correct, Jolie, that they're going to, like, in response to a crisis like the banking crisis or something else on the horizon which we cannot foresee, they want the ability to cut rates further. So I do wonder if they will say, okay, we've tinkered a bit, things have started to break, let's pause or do a slight cut, and then just leave the rates and hold them there for as long as we can to keep draining that liquidity out of the system, and then continue the tightening in the meantime. So because the Fed in America has been criticized for unwinding all of the QT they've done over the last year, or nearly all the QT, within a week. But the part that's not being taken into account in that story is exactly what you said. This is a process, and now that rates are already up there, they can hold them there, and then we'll see that play out over time. So to your question, Cole, where do I think it will go? And this is just general in nature. I do think that from now into 2024, late 2024, we're going to see continuous cuts over that period. But I don't think I don't know if we'll get back down to the lows, but I do think we'll see some easing in Australia and in America.
Yeah, and I think to add to that, there's some minutes, the Reserve Bank here domestically, because we probably didn't touch too much domestically in that update, was the Reserve Bank minutes, the board released the minutes that considered pausing the rate hikes at its last meeting on March the 7th, so a couple of weeks ago now. If the upcoming retail trade and inflation data showed cooling signs, so they were close to actually looking at cooling it and slowing it down, pausing last RBA rate decision. So there's potentially a high chance that there will be a pause of this upcoming Tuesday, first of the month Tuesday in April. So it'll be interesting to see what occurs there and what the minutes come out of that, especially with this additional US financial problems that are adding to the potential case. And we're seeing more and more of these fixed loans coming off, which we've spoken about in previous podcasts, which is just adding to that a lower stimulated environment from an economy side of things. So yeah, so the RBA is becoming less hawkish, and they've opened the door to a pause if the inflation continues to slow and household debt servicing costs have pushed to record levels. So they possibly will soon pause with the US financial problems adding to that case. And then in terms of where my prediction is for the general in nature prediction, probably a similar sentiment to Arnie, where I think they're gonna see a lot unfolding over these next 6 months in terms of the fixed rates coming off domestically. So I'll talk domestically, where they're going to see a lot of that economy be impacted because of that, and they're going to start to get to a point. I reckon we've seen the last of the rate hikes, and I think the next one would be a downwards movement when it is a movement, and it'll be a pause for the RBA historically conservative. So I think it'll be a pause for at least 3-4 months, and then we'll start to see them talk about a potential easing of monetary policy, which would be a look at towards the second half of this year, a decrease in the cash rate. But agreeing with Arnie that it won't get back to previous levels, because that was a bit more of an aberration, unseen, uncharted territory during a global pandemic.
Yeah, spot on, mate. Thanks for the question, Kyle. And keep them coming in, tankers. You can get us at Main Tank on YouTube, Instagram, Twitter, and Facebook. What do you reckon about the 50-50, Jolie?
Yeah, love it, mate. So yeah, you had a 50-50 that you wanted to
I
run
got
by
one.
today, and I've got a food and beverage one as well, mate. So you can run your tech one, and I've got a food and beverage one, because food and beverage ones are always the listeners' favourites.
Yeah, well, they're my favorite too. Let's go 2 for 1. I'll hit you with mine first. So, with the advent of ChatGPT, are you now thinking about swaying over to Bing, or are you a steadfast Google user? Because I'll let you answer first.
I've loved Google Chrome. It's been my adopted thing for probably a decade now, and I do still like Google Chrome, but Bing's been coming up more and more as a bit of a search engine. It's there on my desktop. We operate Microsoft Business 365 at work, so I could see Bing potentially coming to the favour there, and the front of the party, and especially if ChatGPT becomes more of a something that we start to use more and more. Then yes, I'm not beholden to Chrome. I'm not a Chromie junkie that needs to stick with Chroming.
Mate, I'm in the same boat as you. I haven't yet made the switch because I don't know why I haven't, but I'm thinking recently, like, I'm going to get Bing, do whatever I need to do to apply for ChatGPT, and then have a crack at it. But yeah, I'm excited. Oh, what's your food and bevy one?
I don't think we've done this one before, but after a hard week's work, Arnie, come Friday night, and you're looking at opening up a beverage, are you reaching to a red wine or a white wine? Or does it depend on what you're having for dinner?
I would always favour a red wine, no matter what I'm having for dinner. Even though I admit that things pair better with certain wines and foods, but I love red and Pinot Noir in particular. What about you, mate?
Yeah, so if you get a good Pinot, for me, Pinot Noir, that probably is my top of the pops in terms of that would be my go-to. I'd reach for that. But I think more broadly, I tend to like a larger range of white wines. Just the cold refreshment, I guess, depends on what season we're in as well. But a good Pinot Noir is definitely top for me. And then I think if it was any rung beneath that, I'd be reaching for a white if I couldn't get a good Pinot.
Let's be honest, they're both great. I do love white and I do love red, but in the spirit of 50-50, I'll just choose one. But yeah, I love them both as well.
Good, mate. Good. So listeners, keep hitting us up with your great questions, and we'll keep getting up those 50-50s for you guys, because it's all about choice in life, not just financial choices, but lifestyle choices too. We love to bring you to the forefront here and create the diversity and the different approach that people have. So keep hitting up the pod and keep those questions coming in. We love them.
That's the whole point of investing, is to grow your wine collection. What's the point in having money if you can't spend it on wine?
Absolutely. And wine you could almost consider as an asset that increases in value if you get the right stuff. So,
and if you store it correctly, yeah, nice. We're going down a rabbit hole here.
Technically an investment. Anything else from rapid fire news, Arnie, before we say au revoir to the listeners this week?
Oh, I might give rapid fire a miss this week, mate, because I think we've covered a fair bit of what I was going to say anyway. But yeah, I'll have it ready for next week.
Love it, mate. Well, thanks again for joining us today, listeners, in episode 60. Yes, we are into the 60s, and we're on our directive up the mountain to episode 100. Will we get there by the end of the year? Don't know. We might run short, but we're doing really well. We're enjoying the feedback from the listeners. Again, jump on, subscribe, give us your questions. We love hearing from everyone. And in these 60s coming up, this next 10 episodes, we will have some subject matter experts. So keep an eye out for that. There'll be some really great guests to come on, but also, listeners, please reach out to us if you have any guests that you'd like to hear from in terms of a professional sphere in different subjects, because usually with one of our touch points, we've got many different people we can draw upon to come onto the podcast. So feel free to reach out in regards to that as well as dropping us along with your 50-50s and your questions for the week.
Nice one. Thanks, Tankers. See you later.
Thanks, Tankers. Au revoir. Bye now.